Hey there, everyone. Happy Monday, November 25th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully rainy Seattle, Washington, Redmond, Washington, in fact. Thanks for joining me every weekday after the close. We're sort of experimenting with the kickoff time just to see how it sort of fits in, what sort of feedback we can get. So curious what you guys think about starting a little bit after the close and giving a little bit of space. A lot of times when we kick off right at 4 p.m. Eastern, the closing data is not quite there. I'm trying to piece things together, and so waiting a little bit might be interesting. So curious what you think about the kickoff time. Let me know in the comments wherever you're streaming this. We are live streaming on Facebook, LinkedIn, YouTube, and X, and I appreciate so much wherever you're watching this, or if you're watching it on replay. We certainly appreciate you as well. Kind of a choppy day for the markets here on Monday, November 25th, my anniversary. So happy anniversary, Carrie, 24 years ago. All right, let's look at the market recap and focus on how things played out through the course of the day today. This is one of those higher opens, but quite a bit of distribution sort of in the morning session. If you look, the S&P actually spiked briefly above 6,000 at the open today, but actually narrowly, it just briefly dipped below Friday's close right around lunchtime Eastern time. Finished today just around 59.87, and that's up about 1/3% from Friday's close. The Nasdaq Composite about the same. The big winner today, the Dow, up a 1%, a full 1%. But the real winner is down the cap tier, right? Mid caps and then small caps actually having the best performance. The S&P 600 small cap index up about 1.8%. We talked a little bit about small caps last week. We were coming back from a great week in New York, and thanks again for friends and former colleagues and peers in the industry I got to reconnect with in New York last week. A lot of fun, and small caps came up actually a number of times. And I would say, generally speaking, one of the themes that I took out of that week with a lot of conversations was more of a constructive view on small caps, certainly going into next year. That's an area that's been lagging behind quite a bit in 2024. And maybe this is the time when they start to re-exert themselves. So Monday, after getting back, seeing that follow through, kind of interesting to me. The VIX coming down today, finished today right around 14.5, and that's down from Friday's close. Again, the VIX below 20 is sort of that general cutoff for me. VIX above 20 is a high volatility environment. VIX below 20, a low volatility environment, basically tells you not to worry too much about things. All right, looking at the interest rate environment, rates all coming down today. So the 10-year yield came down around 4.27, long bond yield around 4.45, the 5-year point around 4.17. So this is all quite a bit lower from where we were at on Friday's close. At the end of the day on Friday, we're up around 440. We're actually down about 0.1%, a little bit more, about down to 420, 427 or so. So rates are interesting because of the ripple effects they can have on so many different areas of the market. Now, this week, when you think about now that we're sort of through Q3 earnings and what sort of potential catalysts there could be, I would say this week on a shortened holiday week, I mean, not a ton of news flow, but two key things to pay attention to would be the Fed meeting minutes. I think that's on Tuesday, I want to say. And then Wednesday, the latest inflation rating. It's the PCE rating, which is the personal consumption expenditures. While a lot of people key in on the CPI and the PPI, which are more commonly understood and more commonly referred to, the Fed governors have talked about the PCE being their preferred measure of inflation. So when we think about a potential rate cut in December and what that might look like, I would say what happens this week with the latest reading on the PCE is going to be pretty important. The dollar weakening today, a little bit lower for the UUP. That's a bullish dollar ETF. Commodities down in a pretty decent way today. Gold and silver prices both lower. The GLD was down almost 3% today. Crude oil about the same using the USO. And you're going to see that some of the commodity related areas of the market, particularly in the gold space, not doing particularly well today. The GLD chart not looking quite as strong as it was at the end of last week. Bitcoin, while still above 90,000 and actually above 93,000, well off of 100,000, which was a level it briefly touched over the weekend. We didn't quite get all the way up there through 100,000, but we did tease the level. And so Bitcoin kind of naturally, I would argue, pulling off of that level. Today, during the equity trading session, you can see that Bitcoin dropped quite a bit. It was almost at 99,000, now currently just around 94,000. So we're coming off of that sort of the resistance level. That 100K level seemed like in completely unreachable level not too long ago. We're there, right? We're kind of there. So the question is, do we get enough momentum to power above there and make much further highs? Some of the people I talked with last week, Tom Lee of Fundstrat, certainly top of mind along those lines, pretty bulled up on cryptocurrencies with the long-term potential. And full disclosure, I do own Bitcoin. I could see the long-term theory on that one for sure. As a reminder, I can see comments and questions that you're putting on whatever platform you're streaming this on. So if you are watching the live stream, please put comments or questions, particularly as they come up. At the end of the episode, I'll try to take a question or two before we wrap the live stream. And of course, if you're watching this on delay, please just put a comment below wherever you're watching this, most likely on YouTube. I'll look forward to answering your questions, maybe in our next mailbag episode. Looking at sector returns, real estate at the top of the list, the XLRE up about 1.33%. Materials and consumer discretionary second and third, both up right about 1%. Only one of the S&P sectors was really down. Energy was down almost 2% today. I mentioned commodity prices lower, crude oil prices lower, energy getting dinged today pretty good. Technology was basically flat for the day relative to Friday's close. So overall, pretty strong up day with 9 out of the 11 S&P sectors firmly in the positive side. You know, looking briefly at Brett, there's this great widget that's been added to the stock charts dashboard showing advancers, decliners with a kind of a simple heat map visualization. I love that. As we can see today, right, advancers far outpacing decliners. We see that with the cumulative advanced decline lines all starting to rotate back higher. They had been looking a little weaker over the last couple of weeks, right? Some of the breadth conditions had gone, had been really extremely bullish, had come down quite a bit earlier in the month of November. Today, for example, the advanced decline lines sort of renewing that push to the upside. When those are making new all-time highs, it means that the market's in a pretty good shape, right? As long as the advanced decline lines make new highs, that tells you overall more stocks going up than going down. That's probably bullish. And so that's why you want to follow that particular metric. Looking at the Magnificent Seven stocks, Amazon up 2.2%, Alphabet up 1.8%. Those are your top performers within sort of this subgroup of mega cap leadership. NVIDIA down over 4% today. Tesla down 4%. Netflix down 3%. So some of these key benchmark names got hit pretty good. And I would say NVIDIA is probably the most concerning one, right? When you look at the last 6 to 8 weeks, software over semiconductors has been a clear theme, right? Within the technology sector, which arguably has been kind of neutral. It's sort of a market performer. You have stocks like semiconductors, which have been lagging quite a bit. Now, NVIDIA was one of those outliers that was actually doing quite well, despite the fact that stocks like Empower and others were getting absolutely crushed. When NVIDIA is starting to get brought down, that's one of the biggest names, obviously, in the indexes, biggest in the markets. That going down 4% certainly does not help. And that's why small caps in the Dow and other non-NVIDIA types of things were up a lot more today. And Tesla actually featuring a bearish engulfing pattern. I'll show you that in a few moments when we get to the chart review. All right, looking at the MarketCarpet analysis. And as a reminder, when we're looking at a heat map visualization like this, which I love things like this that sort of take a bunch of stuff, take a bunch of names, 500 stocks, and the fact that we can review them at a glance on one screen, I think is awesome. Marvel of modern technology. But let's talk about some ways to make this a practical application of the heat map analysis. 3 things that we look for. Number 1, broad impressions. What are your overall takeaways? Number 2, the big dogs, the biggest names. What are they doing? You always want to be aware of movements there. And then finally, sort of sub themes, right? Sort of clusters of green, clusters of red, things that are outliers, things that are, up in a down sector, those sorts of interesting sort of takeaways. So what's your initial overall impression? I'm immediately drawn to the strength in consumer discretionary. Besides Tesla, it kind of looks like the entire sector is in pretty good shape. I would say the other side of that, the yang to that yin would be the energy sector, almost all in the red. So this is clearly a consumer discretionary up, energy down kind of day when I look at just the heat map and clusters of outperformance and underperformance. A lot of the retail names in there, travel tourism names, et cetera, all having pretty decent up moves. And on top of that, sort of the big box retailers like the Lowe's, Home Depot kind of movers, all having a pretty decent update. So Outside of that, I mean, I would say generally speaking, there's a lot of things to be kind of encouraged about, at least on this particular day. The other big takeaways I would say would be the upper right corner of the heat map. Look at how healthcare was actually pretty strong today, except for things like ISRG and a couple others that were not up. But the average stock in the healthcare sector is actually doing okay. And healthcare is one of those sectors that's been lagging quite a bit. If you look at the last month, I'm guessing healthcare is probably the only sector that's down in the last month. Would be a guess. And if not down, it's probably pretty close to that. Industrials as well in the upper right corner. That's a sector that's actually had some issues here recently. So overall, I would say some of the areas of the market that had been struggling, trying to improve a little bit. Second thing, let's look at the big names, the big dogs. I'm immediately drawn to NVIDIA down over 4%, Tesla down about 4%, Netflix right in the middle, down 3.6%. These are some of the key benchmark names going down quite a bit. So if you're wondering why the S&P was not up more, given the fact that so many stocks had a pretty decent day, it's those big names that have a huge weight in the benchmark were actually down today, and that'll do it. Finally, let's look at some of the smaller individual themes. And again, I'm kind of drawn to some of the stronger performances within the technology sector. Some of these names, you've sort of been breaking out and then kind of pausing, right? Stocks like IBM trying to regain that October high. Stocks like Texas Instruments pulling back from 220, bouncing maybe off of just breaking below $200 a share. Stocks like AMD, which have been really pretty ugly on a relative basis, maybe starting to turn up a little bit. So areas like that have been struggling a bit, actually starting to turn higher. Always an interesting emerging theme to look for. And then finally, the financial sector, right? Ben, which is Franklin Resources, Franklin Templeton, pushing above 22 today. That's a nice follow-through day. Moody's actually making a new 52-week high, very close to a new closing high. I think I might have done it today, up about 2.8%. So there are areas of the market just looking quite strong. And you'll see when we get to the chart review, there are some measures of breadth that are actually looking a lot more constructive here in the last week or two. So those are the takeaways looking at the market carpet. By the way, if you're intrigued by some of the stuff that we show on the show, if you want to learn more about what I call behavioral investing, which is looking at charts, thinking about how we think about the markets by having a consistent process of analyzing the technical analysis patterns, my free behavioral investing course could be just the thing to do when you're looking for something fun to take your time and attention over the long holiday weekend. Go to marketmisbehavior.com/free course. Or just scan the beautiful coffee-shaped mug QR code on your screen. It's a free email course. Would love to share with you some of the things that I've helped people improve on by focusing on the tools you use, how and why you use them, and what sort of takeaways you can take away from your analysis. All right, finishing off, look at what we call the chart review. And as a reminder, I can see questions that you're putting on any platform, so pop them in there as they come up, and I'll try to take a question or two at the end of the live stream here. Starting with the daily S&P 500 chart, you can see we just slightly did indeed test new all-time highs today. We traded above 6,000, which is sort of that high water mark from the beginning of November. We'd pulled down to around 5,850, and as of today, we're popping back up to retest those highs. I mean, obviously, the question when you're in this sort of trend, a clear primary uptrend of higher highs and higher lows, is just looking for signs that that's continuing. So at this point, you're looking for a new high, right? You're looking for the S&P to push to a new all-time high. Then you're looking for a higher low. You're looking for that pattern to continue. So at this point, pushing above 6,000, pretty important. Would not be surprised if we do so, given the general tendencies in a shortened holiday week. In this sort of environment, the general playbook for a week like this is lighter volume than average, usually generally flat to positive price action. It's usually not a huge up week, but it's usually generally drifting higher because less volume. A lot of people are on vacation. A lot of people not making not strong decisions during this week. The trump card, for lack of a better term, the question mark, the one-off story this time is the fact that inflation data comes out just before the holiday, right? So on Tuesday into Wednesday, we've got the Fed minutes, which again is not necessarily new information in terms of a rate change, but it usually gives a little more transparency. And a lot of people are going to be sort of going through that with a fine-tooth comb, trying to get any sort of sense of what that might imply for a potential rate cut in December. which would mean one more rate cut, a final rate cut for 2024. So that's one thing. And then the latest inflation data, and those could have some market moving potential. But again, general base case for a week like this would be lighter volume and generally upward trending price actions, most likely a continuation of the bullish primary trend we've been observing for a while. One of the things I see today that gives me confidence that that's kind of where we're at least for now, is the fact that the newer Dow theory, which is an adaptation, a modernization of Charles Dow's work from the late 1800s, early 1900s, as he wrote essays talking about, what we call Dow theory, looking at the Dow industrials and the Dow railroads, looking at the two main pillars of the economy, modernizing that in this case by looking at an equal weighted S&P 500 and an equal weighted Nasdaq 100, basically looking at the old economy names and the new economy names. Are they in agreement? And as of today, they're both making new all-time highs today. And when that's the case, that is a confirmed bullish trend. When both indexes are breaking out, confirming one another, that tells you conditions are bullish. And that's what I would say. I think I'm pretty comfortable saying trend is undeniably bullish at this point. Now, when the trend is so positive, I am always thinking as a contrarian and looking for signs that we may have some sort of top in the near future. And one of my favorite ways to do that is using what's called the Hindenburg Omen. I did a special video on my YouTube channel on Friday of last week. So if you missed that, make sure you go back. We talked about a couple different things using market trend analysis, etc., but really focused on the Hindenburg Omen. And if you're not familiar with this chart, go back to that video from Friday. Hopefully will be well worthy of your time and attention. But what basically talked about is at major tops, there are some consistent patterns, and that's what this Hindenburg Omen is looking for. It's looking for three different metrics to pop up, and the bottom series is the composite indicator, basically counting how many of those signals are present. And if it gets to a +3, that means all three are firing. Now, a key part of this indicator is you need multiple signals within 1 month. So within 20 trading days, you need to have an initial signal and then a break and then another signal. And that confirmation was one of the things that the creator of this indicator found was so vital. That's happened twice in the last 5 years. The last time was at the major top at the end of 2021. And previous to that was in February of 2020 before the COVID crash. So we've had a couple initial signals, but no confirmation yet. And that's what I'll be looking for now over the next 3 to 4 weeks, is if we get that second confirmation. So we got the initial signal last week. We now have about 3 more weeks to reset. What we would need to see based on the trend in the market would be an expansion in new lows while a bunch of stocks are still making new highs. You need a certain percentage of stocks making new highs and new lows on the same day. That's something we got, I think it was Wednesday or Thursday of last week. And the McClellan oscillator would need to turn below 0, which means the short-term breadth is starting to weaken. So on full alert for that, I guarantee I will share thoughts and observations if and when that would be triggered. But for now, we are in a wait and see mode. We're on red flag alert there for the Hindenburg Omen. Bitcoin, as I mentioned over the week, and that was really on Friday that we just tagged 100,000, did not quite get above there, but we tagged it. The fact that the stock charts chart here says 100K and no longer shows the 3 zeros is just one of those like amazing moments. It never felt like it would actually happen, but we're there. Now, what's happened is we've had a very natural pullback off of that 100,000 level. I mean, I can't imagine a scenario where we would just blow through a huge big round number like that and not at least have a dramatic pause for effect. And I think that's at least what we're experiencing here. So we've pulled back from 100,000. The RSI has been overbought since early November. It's now out of that overbought range. The question would be, do we get back above there? And that could be the sign that 100K maybe in the rear view mirror. For now, we're in pullback mode. Look to see if we make a higher low, where that is. That might reset the overall approach. I want to talk about gold. Gold and other commodities, obviously, getting dinged today. Silver prices down, crude oil prices down. When I look at the chart of the GLD, I'm concerned a little bit about this, what I would describe as a likely change of character, right? I've shaded most of this chart, particularly the RSI, in green. And the reason why I'm doing that is because the entire range of the RSI has been in a bullish configuration. When we've rallied, the RSI has gone above 70. When we've pulled back, the RSI has remained generally above 40. That's all changed in the month of November. We pulled back here, broke below the 50-day moving average, and the RSI actually got all the way down almost to 30. It was around 34 before pushing back higher. And on the subsequent rally, we didn't get up above 60. So all of a sudden, it looks like we might be moving more to a bearish range on momentum. Given today's sell-off and the gap lower, all of a sudden it looks like a lower high around 250 for the GLD. This could be sort of that major topping pattern with a lower high, a lower low, and bearish momentum. I would say gold is certainly in a bit of a dangerous position here. What you want to see is if that swing low from mid-November would hold, and that's around 237, 236, 237 on the GLD. That's where I have an alert set. If we break below that, I think that's pretty much the end of the trend. That's certainly the end of the uptrend, and suggesting that a new primary downtrend is in place, because that would mean lower highs and lower lows. It's looking more and more like that's actually what is happening here. Now, within the commodity space, and this is what I like to remind people, that anytime you see a general trend, a general move, there are often things that are doing quite well. This is the coffee contract. It's only updated through Friday's close, because on StockCharts you only get a daily update on some of these futures contracts. But coffee in a primary uptrend, right, and breaking out. So when I would be hesitant to say commodities are up or commodities are down. Remember in the commodity space, there's energy, there's precious metals, there's soft commodities like grains and soybeans and wheat and corn, cattle and lean hogs and those sorts of things, coffee and sugar and cocoa. And some of those charts actually look quite strong. The DBA, which is an agriculture ETF, combines a lot of those soft commodities into one thing, but some of them, particularly coffee, I think stands out as a strong uptrend. So what's great about our capabilities, or I guess the access you have as an individual investor to markets like coffee and other places, is pretty positive. And I would say there are always some charts that are working out there. So don't limit yourself to certain areas of the market, given your opportunity with ETFs and other instruments, options and so forth, to find opportunities that show technical strength and place your bets there. All right, finishing off looking at some individual stocks, we'll look at a couple of the Magnificent Seven names, particularly Apple. We'll start with Apple. Excuse me, that's how you know it's live. Apple breaking above 236. That would be the question I would look for. 236 was the resistance in July. 236 tested again in mid-October. My question would be, do we have enough momentum to get through there? That's where we've stalled out on these previous rallies here in the last 6 months. I think Apple above 240, which would clear that resistance level. Talk about a dramatically different chart. Here we're kind of creating, I would probably describe this as an ascending triangle pattern, although it's not a perfect one. The lines you would draw to create an ascending triangle pattern, not perfect. This is kind of a noisy, sloppy one, but overall clear resistance around 236. I think that's undeniable. So when that is what the chart is telling you, I'm very happy patiently waiting for a break above 236. And if that happens, if you get a push above resistance and you get the RSI powering above 60, all of a sudden this looks like the initiation of a big move higher, an impulse move above resistance. That's where you would likely see additional buyers coming in, seeing the optimism in Apple, and that's after selling off here around earnings end of October before bottoming out around 220. So potential constructive behavior there on the chart of Apple, but certainly one that's top of mind this week. Now, some of the Magnificent Seven stocks getting dinged. We'll look at two of them today. Netflix coming off today. It reached $900 a share last week. Today, down about 3.6%. Overbought over the last couple of weeks, coming out of that overbought region. So that basically tells us we're likely in pullback mode. I'm immediately looking back to this bullish engulfing pattern from mid-November. That's around 805, 810. That would be an initial downside objective based on the most recent swing low. But overall, let's remember the primary trend is still positive. We're coming off of a new all-time high from Thursday of last week. So overall, I think okay. But on the tactical time frame, this is one of those wait and see as we pull back on the short-term time frame. Speaking of short-term time frame issues, Tesla flashing the dreaded bearish engulfing pattern on today's session. Friday we had an up close. Today we had a higher open and a lower close. So day two's body, the open to close range, engulfs day one's body. When that happens during a primary uptrend, that's called a bearish engulfing pattern. It tells you the next 1 to 3 bars are more likely lower. So on some of these charts like Netflix, like Tesla, it's not giving me a lot of confidence on this holiday week. It's telling me to sort of wait and see and look for some sort of pullback. On the chart of Tesla, as always, you look to the left, clear support short-term around 310s. There's a bit of downside potential to the most recent swing low. And I think that's a decent way to think about potential downside risk until we have more information to base that off of. Wanted to leave Palo Alto Networks. I actually included this, I think, on Thursday's show of last week before I left New York. They reported earnings last week on the 20th. That was Wednesday. And overall, I would say the chart of Palo Alto is a bit of a concern only because we cleared that February peak. We made a new all-time high. That's really continuing this uptrend. And while the primary trend is still up, now we're actually back right below that. We're testing that breakout level. So I'd love to see this hold and then sort of resume that uptrend. So higher lows are good. Holding above an ascending 50-day moving average is good. Overall, I would say this chart is still fine. But think about what you would see on this chart that would tell you maybe something different. For now, I would say that's a pretty strong chart. There are other strong charts as well in the gambling group and consumer discretionary. Flutter Entertainment, FLUT. They reported earnings a couple weeks ago. You can see the gap higher on their positive earnings result. This is illustrating what I call the gap and run pattern, where you have a gap higher. We really don't come off at all. What this is telling you is even though we gapped up on earnings, we're now seeing additional buyers thrilled to own this stock at a premium, right? We're bidding the price higher, but you're still seeing buyers coming in, pushing the price higher. The relative strength making a new 12-month high today, which I think is pretty encouraging as well. I want to thank so much everyone watching. I'm going to take a question or two, and then we will wrap up the live stream. And again, thanks for your flexibility this week on the holiday week as I work around family visiting and everything to make sure I get some market updates for you as quickly as I can. All right, coming to us from YouTube, you asked, Dave, what's your view on the best day of the week, best time of the month traditionally to buy stocks? I love that question. What an interesting question. So how would I answer that? I'm not a big fan of like days of the week as a particular indicator. And I will tell you, and I've seen plenty of statistics on this. And again, I'm a huge fan of Jeff Hirsch, who's at the Stock Traders Almanac. His father, Yale Hirsch, really pioneered the concept of seasonality and seasonal trends, things like the Santa Claus rally, things on, sell in May and go away, and some of those things that we all sort of take as trading maxims. He more than anyone sort of popularized that through writing the Stock Traders Almanac, through a lot of his original work, and his son Jeff Hirsch has continued that in I think a very positive way. Having said that, I know they do a lot on like days of the week, days of the month, right? The 15th has a certain, hit rate or a certain average return. I am not a huge fan of that, only because I think trends and price action is really more about the investor psychology at that particular time. So taking the average Friday, what does that mean? I'm not a huge fan of that. I would say the best time of the day or the best day of the week to take action is when the signals are clear, and when you get a clear signal on the charts, it would be my answer. Now, the best time of the month is a little different, and I would point you. I don't have time to go in too much detail, but there's a really interesting book. I think it's behind me, and I was going to show it to you. It actually isn't, but I thought it was going to be, and I'm going to try off the top of my head to remember what it's called. It's called Muscular Investing by Brian Livingston. And I'm really sorry if it's not that exact title, but something really close to that. I think it's Muscular Portfolios by Brian Livingston. Brian Livingston is definitely the author's name. I'm not a fan of everything. I mean, a lot of his book is sort of an aggressive, active management doesn't work kind of approach, which I don't agree wholeheartedly with all that. But he actually did do some really interesting statistical analysis on what, time of the month to do things. And he basically said at the end of the month, statistically is the best time to be, getting into new positions and to be, particularly getting into things that have done well in the previous month. Why that would play out, I think, is open to a lot of speculation. But I thought some of his work along those lines was interesting. So I'd point you to that as a potential way to maybe fill in the blanks. Again, I'm a fan of the Stock Traders Almanac that Jeff Hirsch publishes, continued to this day every year. I get it every year. I would encourage you to check it out as well. And I'll put a link in the description if you're not familiar with it, want to learn more about it. But having interviewed Jeff a number of times, he's done better work than anyone I've seen at looking at statistical anomalies on certain types of the year in particular that I think are fantastically helpful. All right. Question, Matt, on X. Time for a gander at the VIX and the McClellan oscillator as requested. Happy to do so. All right, looking at the VIX, I actually didn't talk about the VIX today, just briefly, but, looking at the VIX, I mean, generally speaking, volatility has come down. The MOVE index, which is sort of like the VIX for the bond markets, also coming down quite a bit. You know, when you have a market that has had such a strong run like we've experienced in 2024, I have a market top checklist with 7 things that I look for that are just sort of those pretty common things that tend to happen at major market tops. One of those things is a spike in volatility. Because when the market has been gone up a lot, when investors, I feel like, are sitting on a lot of paper gains, and when things start to turn lower and when they start to panic and they're afraid they're going to lose all of those paper gains, they start to take profits and sell. That's what can create what's called a waterfall decline. I just saw Ralph Acampor in New York. He said, again, the market goes up the stairs and down the elevator. And that's what happens, right? As the market's in like this low volatility incline going up, people are sort of slowly accumulating positions, riding the price higher. But when things start to turn, that's when people panic. And you don't panic and sort of gently sprinkle sell orders. You kind of dump everything because you just want to get it out and make sure you don't lose anymore. And that's what creates this rollover. So a spike in the VIX, particularly at this stage, often means an aggressive sell-off. That's why we were sounding some serious warning bells in early, sort of late July, early August, because we saw the VIX spiking to one of its highest levels in history. And we're thinking, wow, this could be how the next big crash sort of starts. It ended up not lasting too long, right? It ended up being about a 10% pullback from mid-July to early August. But I don't have a problem with, you know, watching spikes in the VIX and moving to the exits, or at least getting very defensive. And just because the possibility of it becoming a big sell-off is very real. So for now, volatility remaining low. Volatility for bonds, which is called the MOVE Index, very low as well. We'll continue to monitor those and see if they change. But for now, all is well there. The McClellan oscillator did go back above the 0 line on Thursday of last week, if I remember right, still remaining above there today with the positive accumulation. The reason why this is so helpful right now, I mentioned that video on the Hindenburg Omen, and I'll put a link in the description on my YouTube channel for that one as well. I would encourage you to check that one out because it goes in a little more detail on the Hindenburg Omen. But one of the 3 factors in there is the McClellan oscillator going back below 0 after it's been positive, because positive McClellan oscillator means short-term breadth is good. The McClellan oscillator rotates lower. That often happens at a major top as the breadth conditions start to rotate. So even though the S&P or the Dow are still strong, the breadth rotating lower tells you there's some selling happening. It's just not being reflected in the indexes just yet. So in answer to your question, both of those, okay. And I think the reason why it's important to watch them when they're okay, because at some point, probably not far off, they will be not okay. I hope you continue to watch this show, and I will gladly tell you when that not okay time is here. Folks, I want to thank you guys so much for joining me. If you're watching the live stream, if you're watching it on replay, I appreciate you as well. Please keep your great questions coming and your comments as well. I appreciate all of them. Certainly appreciate your feedback on the show and how we can improve things as we start to look forward to into year end and the beginning of next year. We'll do an adjusted schedule this week. I'll let you know as I get closer to the holiday, but overall, wish you all a very happy and safe and joyful Thanksgiving week. For Market Misbehavior, I'm Dave Keller. And remember, it is always a good time to own good charts. Have a good night, everybody.